The airline would like to apologize for the delay to your flight. A familiar announcement at airports around the world announced back when we could travel freely. This is due to the arriving aircraft's late arrival. This, however, effectively states that we are late because we are late. Of course, this is true. Delay breeds delay. Prices show a similar tendency. Prices rise as a result of price increases. We experience inflation as a result of inflation. When consumer price inflation has been relatively modest and stable over the previous 20 years, there has been a significant increase in price increases in recent months, as well as much debate about the role of supply chain disruptions. Hey, welcome back to Economic Insiders. Give this video a big thumbs up, and don't forget to subscribe to this channel. It's free. Now, let's move on. Before 2020, few individuals outside of a limited number of experts would have predicted that a worldwide epidemic would bring the world's economy to its knees. Today, as we recover from the crisis, we are similarly unprepared to deal with an unexpected disruption in supply. So, yet, it appears to be a momentary malfunction, but it might develop into a serious problem with far reaching consequences for the world economy. Months of cutbacks, idled facilities, and order cancellations affected the production of several supplies, creating severe issues in the face of rebounding demand. Bottlenecks are exposed in industries that were ill prepared to raise capacity fast, such as packaging materials. Workers are staying at home due to a mix of unemployment checks, children kept at home, and dangerous working conditions, resulting in a labor bottleneck. Rental car fees are skyrocketing due to a variety of causes, including a scarcity of vehicles. Housing prices have risen in several areas as inventory has dropped to historic lows. The list goes on and on. Ongoing issues in transportation from manufacturers to customers keep forcing up the prices of automobiles, computer chips, furniture, and other things, pushing consumer prices up at the worst rate since 1982 in December. According to numbers published Wednesday, the consumer price index rose 7% in the year through December, and 5.5% after volatile prices such as food and fuel were excluded. In the year to December, the price of used automobiles and trucks soared 37.3%, while food rose 6.3% and clothes increased 5.8%. Price hikes were also fueled by increases in the cost of electricity and rent. Supply chain disruptions from China to California to Europe have led to unpredictable products being currently out of stock, with some consumers eager to buy more for stock, escalating the shortages. Central banks may continue to believe that the recovery is weak and that price pressures are temporary. Instead, it appears that they will adopt a more cautious strategy, responding to inflation in the rear view by applying the brakes in case something worse is coming. The Fed anticipated no interest rate hikes in 2021 or 2022, as recently as last December. All the buzz these days is about when bond purchases will be cut down and interest rates will have to climb to keep rising inflation in check. The central banks continue to argue that inflation will drop, but they are expressing indications of wavering in their determination to keep the money so loose and focus on encouraging recovery. Interest rates in South Korea, New Zealand, and Norway have surged by 0.25% from their low levels, with hikes reaching 7.75% in Brazil, 1.8% in Hungary, 4.75% in Mexico, and 7.5% in Russia. So far, the Fed and the ECB have resisted tightening, but they are shifting their terminology and evaluating their policies as they are forced to significantly adjust their projections. They must prove that they are reacting to the circumstances. Is the market right in fearing inflation? Researchers that have looked into this aspect are skeptical. Historical data shows a connection between inflation and equities returns, but this is not consistent over time and may have been biased by the 1970s, a period of high inflation and poor returns, as well as static disposable income. Unlike the 1970s, today's consumers benefit from significant savings from months of low spending, increased unemployment benefits, and stimulus funds. The economy came to a standstill in record time and is now ramping up to the greatest growth in decades. This rapid back and forth caused a slew of dislocations, making it impossible to predict where it will rest. What comes next may be the old normal or a new normal. Of course, The following several quarters will provide more clarity, but from what we can see today, the bulls have a stronger chance. So, price hikes might feed higher prices up the supply chain. The risk that central banks want to avoid is a popular perception that higher price increases will become the norm in the future. This means that even temporary price rises will be passed on to customers, increasing the risk of inflation, a self fulfilling destiny. However, hiking interest rates, which is the conventional tactic used by central banks to combat inflation, risks worsening an already fragile economy that is still plagued with uncertainties. This is one of the tricky balancing acts that will engage policymakers' minds in 2022.